Hi everyone, thanks for joining us. I'm Jason Ferris, and I'm joined by our Chief Investment Officer, Jason Eliason. Now that quarter one has ended, I wanted to discuss a few key events that happened over the last quarter. We just closed out a pretty solid quarter of investing. What are your initial thoughts regarding what's transpired, Jason?
Happiness was the first thing that came to mind. It was nice to see that we had such a really good quarter. In fact, that was the best quarter for stock investing since 2009. Of course, it comes on the heels of one of the worst quarters that we've had in the last decade. My initial reaction to the quarter was trying to focus on understanding what changed. The last two quarters really epitomize the term volatile market. A large part of the great performance of this first quarter was simply a rebound from the overreaction and excessive selling that helped drive stock prices lower in December. Economically though, not much has really changed the last 6 months, which is really reassuring. In fact, if we remove the day-to-day movements and just examine where we are today compared to where we were 6 months ago, I think we're right where everyone would expect. However, that journey was anything but smooth.
So you mentioned not much has changed economically speaking over the last 6 months or quarter. But bring us up to speed. Is anything happening with the Federal Reserve? What's going on with policy? What's transpiring there?
Yeah, certainly. That's a great point to bring up the Fed. They've really changed their tone quite a bit really in the last few months. Last year we saw 4 interest rate increases throughout the year, and they also set the expectation that we would see more interest rate increases this year. Throughout their process though, they continually maintained that they would be data dependent, meaning they would focus on what's really occurring and then react to that and change their actions accordingly. I'm pleased to see that that's what they're doing. Interestingly, they raised rates in December and of course outlined at that point that they'd expect more increases in 2019. And then in late January, which was only really a few weeks later, Chairman Powell came out and commented that future interest rates may not be necessary. During their meeting in March, the Fed voted unanimously to leave interest rates unchanged, which that was expected. However, their language they used really softened quite a bit, and they stressed the need to be patient and flexible, which is really what we like to hear. They also updated their projections to indicate that no additional interest rate increases are expected for the remainder of this year. The markets reacted very favorably to this.
Given the extreme shift from December to today, it feels like something more sort of transpired or happened in the marketplace. But fundamentally speaking, has that changed much?
I'd say that's correct. Not really much has changed. Fundamentally speaking, the economy has not really shifted in the last couple of quarters, and on a quarter-by-quarter basis, that's a very short period for an economy. There's no rational explanation as to why the market sold off so sharply at the end of the year, and of course subsequently rebounded this year. The reality of investing is that, and especially over short periods of time, the market can be very irrational. That's one of the reasons why we hold diversified portfolios, and we use these sharp movements in prices as an opportunity to rebalance portfolios. That is also why we allocate to a portfolio to different buckets or tranches of risk and time. It's only money that we have a high degree of confidence that we will not need for at least 5 years that we even allocate to stocks. It also underscores the importance of knowing your personal situation. We cannot get into a situation where we are forced to liquidate a stock or position at a depreciated price.
So looking ahead, are there any thematic changes or structural shifts you anticipate occurring over the next quarter?
No, nothing that I would say is likely. I do anticipate the U.S. economic growth slowing a bit, but nevertheless, I always tell people growth is still growth, and being patient right now is going to be key. I'm concerned about what's happening in the UK with Brexit, and I'm also a little bit concerned with the US-China trade policy. Despite those things, I remain slightly optimistic about the near-term outlook for the US market. Clearly though, we're definitely becoming more cautious in our stance. It's a good time to remind people that trying to time markets on a day-to-day or month-to-month basis, it's really futile. We're steadfast in our belief that portfolios should remain diversified and rebalanced as opportunities present themselves.
Thank you, Jason.
Yeah, of course.
And thank you for joining us. I hope you found some of this information helpful. Jason Eliason also wrote a full report. If you'd like more information, check out our website, waller.com/blog.